Here's something that drives me crazy about high-yield ETFs. You see a fund paying 15, 20, even 25%. You buy in. The dividends hit your account every month. Feels great. But then you check the share price 6 months later, and it's down, way down. That 20% yield, it wasn't coming from profits. It was coming from your own money being handed back to you. That's called NAV erosion, and it is the single biggest hidden cost in dividend investing right now. But here's the good news. Not every high-yield ETF does this. There are funds out there paying double-digit yields, and their share prices are actually going up, high yield and capital growth, together, in the same fund. In this video, I'm going to show you 8 specific ETFs that have shown zero signs of NAV erosion in 2026. We're talking yields from about 6% all the way up to 29%. And as a group, their average total return over the past year has been roughly 30%. By the end, you'll know exactly which funds they are, why they work, how to test any ETF for erosion yourself, and how to put these together into a portfolio that actually protects your money while paying you real income. And one of these picks, I'll save it for later, has returned over 100% in just 1 year without eroding a single penny of capital. Stick around for that one. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. All right, let's get into it. The 30-second test that catches NAV erosion. Before I show you the 8 ETFs, I need to teach you one thing, because once you know this, you will never fall for a yield trap again. It's a 30-second test. Here's how it works. Pull up any income ETF on a charting tool, Stock Analysis, TradingView, Yahoo Finance, whatever you like. Now look at 2 numbers. Number 1, total return. That's the performance including dividends reinvested. Number 2, price return. That's just the share price, no dividends, just what the fund itself is worth. If the total return is up 20%, but the price return is down 5%, you've got NAV erosion. The fund paid you dividends, sure, but it shrank your capital to do it. Here's the math in plain English. NAV change roughly equals total return minus the distribution rate. So if a fund earns 9% and pays out 8, your NAV grows by about 1%. That's healthy. But if a fund earns 6% and pays out 15, well, that 9% gap, it's coming straight out of your principal. That's your money disappearing, and it adds up fast. The 8 funds I'm about to show you pass this test. Their price returns are flat or positive. The yields are real. The capital is intact, and some of them are actually growing in value on top of the dividends they're paying. That's rare, and that's what makes this list worth your time. So now you know how to spot the problem, but here's the real question. Which ETFs actually survive the test? Let me show you, starting with the 3 strongest picks on this entire list. The Core 3. These first 3 are what I'd call the foundation. They have the longest track records, the largest fund sizes, the lowest fees, and the clearest evidence that their NAV is not eroding. If you only pick 3 from this video, make it these 3. Number 1, GPIX, the Goldman Sachs S&P 500 Premium Income ETF. This one's a standout. It holds the S&P 500 and writes call options on top to generate income. It launched in October 2023, so we've got close to 3 years of real data now. The yield is about 8.7%. The expense ratio is just 0.29%. That's the cheapest on this entire list by a wide margin. And the AUM is over $4 billion. It's big, it's liquid, and Goldman isn't shutting this one down anytime soon. But here's what I really love about GPIX. The 1-year total return is about 20%, and the price return, just the share price, no dividends, is up roughly 10 to 11%. That means the NAV actually grew. You got paid about 9% in income, and your investment went up in value.
That's the gold standard for a no erosion ETF. That's what you want to see. Number 2, IWMI. The ENEOS Russell 2000 High Income ETF. This gives you small cap stocks, the Russell 2000, 2,000 smaller American companies. The yield is about 13 to 14%. It uses index options structured under Section 1256, which means 60% of the gains get taxed at the long-term capital gains rate, even if you held the fund for less than a year. Smart tax structure. 1-year total return is around 17 to 18%. Price is held steady, no erosion. AUM is about 470 million and climbing. Now, here's why this one matters. If you already own S&P 500 or NASDAQ funds, and let's be honest, most of us do, you're already heavy in big tech. IWMI gives you exposure to a completely different part of the market, smaller companies, different sectors, real diversification, plus income. Number 3, IDVO, the Amplify International Enhanced Dividend Income ETF. This is the international play. It holds dividend-paying stocks from outside the U.S. and adds a selective covered call overlay on individual names. The yield is about 6%, lowest on this list, but the total return tells the real story. Since its launch in September 2022, IDVO has returned over 105% total. Let me say that again, over 105% in under 4 years. That's about 21% annualized. It carries a 5-star Morningstar rating in the derivative income category, and its AUM just crossed $1.3 billion. International stocks have been quietly outperforming the S&P 500 for the better part of this year, and IDVO has been riding that wave while paying you along the way. So, GPIX, IWMI, IDVO. 3 different markets, 3 different strategies, all verified, 0 erosion. That's your core. Quick question before we move on. Of these 3, which one would you add to your portfolio first? Drop it in the comments. I read every single one, and I'm genuinely curious what you guys are leaning toward. The high growth plays. All right, now we're going to step up the risk a little. These next 2 picks have shorter track records and more volatility, but the returns have been hard to ignore. Number 4, TADQ, the TAP Alpha Innovation 100 Growth and Daily Income ETF. This is your NASDAQ 100 play. It uses 0 days to expiration options, 0 DTE, to generate daily income from the biggest tech names. The yield is about 17%. It launched in September 2025, so the track record is only about 10 months. But in that time, the price has held near its highs, total return has been solid, AUM is 267 million and growing fast, and the distributions have been roughly 100% return of capital. That matters for taxes, and I'll come back to that in a minute. The trade-off? 10 months is not a lot of history, and 0 DTE options are more aggressive than traditional covered calls. In the March pullback earlier this year, TADQ dipped harder than the conservative funds. It bounced back, but you should know it moves faster in both directions. Number 5, SOXY, the YieldMax Target 12 Semiconductor Option Income ETF. This is the one I teased at the beginning, and the numbers are, honestly, let me just tell you. SOXY holds 15 to 30 semiconductor stocks, NVIDIA, Broadcom, Marvell, Lam Research, Applied Materials, and writes covered calls on them while targeting a 12% annual distribution. It launched in December 2024. 1-year total return? Over 114%. Some data sources show closer to 145%. The share price has roughly doubled. That's not a typo. The semiconductor sector has been on a historic run driven by AI demand, and SOXY has captured a massive chunk of that move while paying monthly income. But, and this is a real but, this is a sector bet. Semiconductors have been one of the hottest sectors of the last 2 years. That momentum won't last forever, and when semis pull back, and they will at some point, SOXY will feel it hard. Its worst single day on record was a 9.4% drop back in June. The AUM is also small, only about $27 to $31 million. Funds that small carry a real risk of closure if assets don't grow. So treat SOXY as a satellite position, not a foundation, a small slice that gives you exposure to the upside without betting the farm.
Now here's a myth I hear all the time. Here's the myth. If an ETF yields over 10%, it must be eroding your capital. Here's the truth. It depends entirely on the strategy and the market the fund operates in. GPIX yields about 9% with growing NAV. SPYI targets 12% and the price doubled. Meanwhile, some funds on the S&P 500 paying 30% yields like XDTE are clearly eroding because the S&P itself only returned about 9% this year. The math simply doesn't work at that payout level. The yield number alone tells you nothing. The test is always the same. What is the price return doing? So now you've got 5 strong picks, but there are 3 more, and this is where I'm going to be more honest with you than most channels will be, because these next 3 have a catch: the alternative assets and the honest truth. These last 3 picks add diversification through commodities and energy, but I need to give you the full picture, not just the numbers that look good. Number 6, KGLD, the Curve Gold Enhanced Income ETF. Distribution rate about 16 to 18%. Expense ratio 1%. AUM just over 100 million. Number 7, KSLV, the Curve Silver Enhanced Income ETF. Distribution rate around 29%. Same 1% expense ratio. AUM about 90 million. Gold has been strong in 2026, silver even stronger earlier in the year, and the Curve funds have delivered positive total returns since launch. But here's what I won't hide from you. Both of these funds took significant hits from their peaks. KGLD peaked around $43 a share earlier this year. Right now, it's near 26. KSLV peaked around 60 and dropped to about 29. Those are real declines in your principal. Now, is that NAV erosion in the traditional sense? Not exactly. When gold drops 30%, a gold income fund drops with it. That's the underlying commodity falling, not the fund's strategy eating your money. There's a difference. But it also means no NAV erosion is only half the story. Your capital can absolutely decline when the asset underneath drops. And with a 1% expense ratio, 3 times what GPIX charges, you're paying a premium for that ride. So keep KGLD and KSLV small, a 5 to 10% allocation to hard assets with income, not a core position. Number 8, NDIV, the Amplify Energy and Natural Resources Covered Call ETF. Yield around 7 to 10%, expense ratio 0.59%. It holds energy and resource names like Petrobras, Dow Chemical, and LyondellBasell with a covered call overlay on top. Performance has been solid this year, but here's the red flag. AUM is only about $27 million. That's tiny. Funds that small can get shut down if they don't attract more capital. It's not a reason to avoid it entirely, but it is something to watch. Check the AUM every few months. If it starts dropping, consider moving on. Those are your 8 picks, but knowing the names is only half the battle. Let me show you how to actually put this together. Building the portfolio the smart way. So let's zoom out and look at all 8 together. GPIX for the S&P 500, IWMI for small caps, IDVO for international, TADQ for NASDAQ 100, SOXY for semiconductors, KGLD for gold, KSLV for silver, NDIV for energy. 6 different sectors or asset classes. Very little overlap in the actual holdings. Yields ranging from about 6% on IDVO all the way up to 29% on KSLV. But here's what smart investors understand. Not all 8 deserve equal weight. Think of this portfolio in 2 tiers. Tier 1 is your core, GPIX, IWMI, and IDVO. These have the longest track records, the biggest fund sizes, the lowest fees, and the clearest proof of zero erosion. They should make up the bulk of your allocation. I'm talking 60 to 70%. Tier 2 is your satellite, TADQ, SOXY, KGLD, KSLV, and NDIV. Higher yields, higher risk, shorter histories, smaller funds. Keep each of these at 5 to 10%, enough to benefit from the upside without getting hurt if one stumbles. Now, if you're between 25 and 50, here's something most channels skip. Where you hold these matters almost as much as what you hold.
Funds with high return of capital distributions like TADQ, IWMI, and IDVO are actually very tax efficient in a regular brokerage account. Return of capital isn't taxed when you receive it. It just lowers your cost basis. You don't pay taxes until you sell.
But funds that pay mostly ordinary income, think JEPI and JEPQ style payouts, those should go inside your Roth IRA or traditional IRA, where the tax hit doesn't matter. And here's one more thing I'll say, because I think it needs to be said. If you're in your late 20s or 30s and you don't actually need the monthly cash right now, ask yourself a real question. Do you need income or do you need growth? A total return growth fund like VOO or QQQ compounds faster because it's not creating taxable events every single month. Income ETFs are powerful tools, but they're most powerful when you actually need the cash flow. Don't chase yield just because the number looks exciting. Chase it when it serves your actual financial plan. Here's the line I want you to remember from this whole video. A high yield that shrinks your capital isn't income, it's a refund. Real income grows while it pays. Write that down, screenshot it, tell your friends. Speaking of friends, if someone you know is chasing high-yield ETFs without checking for NAV erosion, share this video with them right now. You might save them from watching their portfolio slowly shrink without even realizing it. I want to hear from you. Are you going to build a tiered portfolio like this, or do you prefer keeping it simple with straight growth ETFs? Let me know in the comments. If you are serious about building real income from your investments and you want to stay ahead of what's changing in this space, subscribe to this channel. I break down this stuff every week so you don't have to figure it out alone.